Hello and welcome. You're watching KYC here on NDTV Profit. I'm Harsh Saita. Now, on to the company that we're going to track in today. It's going to be KFin Technologies. Outside of it being a darling with regard to the theme that it covers, which is Indian capital markets, and given the fact that it's so much more domestic facing and so less impacted by all the geopolitics that's going on globally, from a business standpoint, of course, maybe not from a client edition standpoint, but from a purely business standpoint, and hence we feel that this one surely entails, or rather deserves conversation. So let's quickly put out as to why we've picked KFin. The first one, of course, the big theme being Indian capital markets, and this is a clear play with regard to Indian capital markets. In terms of growth, it's a high growth company, recently listed. Whether this growth can really sustain is the question that we'd like to ask them. The other one is market share gains. So while we've seen very strong growth come through for a company like this, we're not seeing very strong gains in terms of market share. Is that really something that we should be concerned about? The fourth piece is possibly chances of yield compression. Mind you, a lot of their revenue is linked also to how mutual fund SIPs and mutual fund flows are, and it's a variable revenue based on the quantum that is being invested, and therefore any tweak in the yield could impact profitability. The fifth one is with regard to AUM growth and flows. This could, of course, well get impacted if markets don't perform. So that's one possible, very real risk which the company carries. And the last one, or the second last one rather, is the risk of regulatory changes. Any changes with regard to regulation could impact the revenue as well as the model, the business model itself of the company. They are also going global. So the global foray, what should we expect from this? Because incrementally it adds in terms of the acquisition that they've made of Ascent, adds to the revenue, the top line of the company clearly right from day one. But what does it mean from a big picture standpoint? What does it mean for cash flows? What does it mean for valuations at this point? Is it looking good, and is this the best play in that sense for playing the capital markets? And we'll try to discuss and break down all of these angles and aspects. Let's first talk about what KFin does. Let's try and simplify it. So first one, it's a technology-driven financial services platform. In the most basic sense, it helps investors as well as mutual funds, as well as AIFs, as well as a PMS in terms of client onboarding and purchasing of units. So it caters to the capital market ecosystem. That's the theme it caters to. It's the largest investor solutions provider to Indian mutual funds. In fact, it boasts to service 26 of the 48 mutual funds in India, AMCs in India. Now, let's break this down a little bit further. First, on the investor solutions side of things. One, it provides solutions to asset managers, corporate issuers across asset classes in India. It services around 26 of 48 AMCs in India, and these are broadly the solutions that they provide. So all of these are provided by KFin Tech to the service recipient. In terms of issuer solutions, mind you, this includes IPOs as well, but I'll try and trim it down and say that these are only corporate issuances, and the largest issuer solutions provider in country in terms of number of clients. It also offers investor and issuer solutions, and it caters to over 7,000 corporate clients currently. It also does international investor solutions. The piece at this point is small, just about maybe very, very low teens, or maybe just 12% of top line, but that share might likely go up because they've acquired a business in Singapore, and we will talk about that as well. The fourth piece is with regard to AIFs and wealth investor solutions. They command a 37% market share within this space. and therefore something to look out for as well. The National Pension Scheme, the NPS, it has 15 lakh subscribers within the NPS and growing fast. Currently just 9.5% of the market share it commands in this space as well. So has good potential for growth in this pocket as well. In terms of metric, it's a market leader. The domestic mutual fund investor, the overall AUM or market share is around 32.1%. This is FY24 numbers. We'll talk about the current numbers as well. The equity AUM market share is around 33.5%. And we also have the SIP market share, which is almost 40% of the monthly SIP inflows. These are all FY24 data, which I'm culling out, but largely it's stable across the 9 month as well. In terms of issuer solutions, it commands 46% of NSE 500 by market capitalization and 42% by number of folios, and in terms of number of companies, it's around 37%. So number of clients around 37%. So that's how the split is made. In terms of revenue mix, around 72%, 73% of the revenue comes from domestic mutual funds, around 13% from issuer solutions, again around just about 12% from international, we spoke about this, and around 3% from other business services. So that's broadly the breakup. The largest chunk of that is domestic mutual fund investor solutions, and they are diversifying fast away from that, or rather focusing on that and along with it doing other things. Let's look at the AUM trend now. Now this is where it starts to get very interesting, and we have 9 month FY25 numbers for perspective. Look at the AUM. The AUM trend is clearly on an uptick. You're seeing almost 2.5x in terms of the AUM versus FY21, currently at FY25. So looking very healthy, but let's look at the market share here. It's gone up from 27.5%, very, very slow climb to around 32.5%. It's taken them around 5 years, 100 basis points each year. Roughly, that's how it's gone up. The other one is the equity AUM, and this is pure equity. Look at that. That's gone up 3x in the last maybe 5 odd years. And you're looking at market share, which is up from 32.5% to just 33.4%. So no real trend here. This is where there could likely be a concern. Market share gains may not be happening, even though growth is extremely strong. So while that is a big positive, can they gain market share? Because that would be a double engine, which could be formidable. Investor folio trend as well. Investors have doubled virtually in terms of folios between FY21 and FY25. So in the last 4 odd years, the investors have virtually more than doubled. So that also is positive. The key here is going to be market share and whether they can play that well enough or not. Okay, let's now quickly look at the metrics we'll track on this one. And I'm going to keep this as quick as possible. Income statement, balance sheet, cash flows, return ratios, shareholding pattern, valuations, street cred, and street coverage. We'll cover all of those 8. Let's quickly look at the income statement. Again, no concern with regard to growth here, as one would expect. 20% 3-year CAGR. Look at the last couple of years, 720 crore being the top line FY23, FY24 was 840 crore, and FY25 is going to be more than 1,000 crore likely. That's the likely glide path that the revenue is taking, at least at this point. EBITDA as well growing in line, 20%. The margins, there's been a slight bit of dilution versus FY22 from 45%. It's come down to around 43.8%. It was down to nearly 40% and thereafter has rebounded. Net profit also fairly healthy clip in that sense, 29% 3-year CAGR with regard to net profit. Clear thumbs up. Not too many businesses that can do this and looking sustainable as well in terms of how they are doing it. 808 crore is the number, 9-month FY25 growing at 32%. Look at the EBITDA number, 36%. EBITDA margins coming in at 44.1% and a profit after tax of 250 crore versus the 250 crore they did in full year FY24, clearly demonstrating nearly a 30% plus kind of growth clip. So clear thumbs up with regard to income statement. No questions asked. Balance sheet. Again, balance sheet looks good. You're seeing around 170 odd crore of equity. Mind you, the the market cap of the company is roughly 20,000 crores. So it's nearly 15 times the current, or rather around 12, 13 times, 14 times the current equity share base, and therefore price to book is quite high in that sense. You're looking at reserves, healthy reserves that the company is sitting on, and cash and bank balance too is fairly decent, around 250 crore of cash bank balance. Of course, some of this will go in the new platform that they've invested in, which is Ascent, which is to help them go global with regard to the services they are providing. Want to quickly add, debt is negligible to very low, and therefore clear thumbs up with regard to the balance sheet as well. Let's look at cash flow. Again, you're seeing a healthy growth in terms of cash flow, near 30% growth, H1 FY25 versus H1 FY24. And what you're also seeing is largely in line with the kind of profits that they're making. And therefore, no concerns there. With regard to the cash flow, the growth clip is quite decent and in line with the way in which the EBITDA metrics are playing out. Net cash flow may be negative, but they are making heavy investments in their back end, and therefore that makes sense, at least at this point. But therefore, what becomes more relevant is the return ratios. Look at the ROC number, look at the ROE number. ROC above 25%, well, on a consistent basis over the last 3 years. ROE is also above the 20% mark over the last 3 years, and therefore, would you mind whether this company is really making investments straight back into the platform that it services? Maybe not, and therefore a thumbs up with regard to return ratios as well. So at least these 4 metrics is a clean thumbs up with regard to operations. They're doing very well there. Now let's look at shareholding, and this is where it starts to get tricky. Now, first thing, I want to highlight the kind of shareholding changes that have happened, and within that, of course, the last 3 months not reflective of those changes, but promoter holding has fallen from 39% at the end of FY24 to around 33% at the end of FY25. So something to keep in mind, promoter holding has shrunk, but you're seeing very strong interest from FIIs as well as DIIs. Both of those largely, DIIs maintaining their stake of 20%, FIIs have actually hiked their stake from 16.5% to nearly 23%, and that is a clear positive. But the promoter ownership falling slightly, even post the IPO, it's fallen, and therefore we'll give this a neutral on that count, and something that we'll watch out for as well. The other piece is with regard to valuations. Now, when I'm looking at the valuations of the company, it's valued richly in comparison to peers, deservingly so. It's in a business and it's growing faster than peers. If you look at the shrink in terms of price to earning ratio, current versus 1 year forward, the shrink is the sharpest when it comes to a KFin versus pretty much all other players. Prudent, slightly different business in that sense, and therefore that shrink I'm not completely factoring in. But what you'll see is while it commands a premium, it also anticipates a better growth clip in terms of the way the street is seeing it. Therefore, we'll give this a neutral. Street coverage, 10 analysts have a buy, 3 have a hold, 3 have a sell, negative 8% in terms of return expectations. So street coverage will give a thumbs down simply because the return expectations, negative 8, despite 10 analysts having a buy. But the return expectations not good. We've seen a sharp run up on the stock price, and that's what gets me to the street coverage. 1 month returns are 9%, 3 months are 15%, 6 months are 25%. There's been a sharp fall in the stock price. Thereafter, there's been a recovery, and now we've seen a very strong recovery. But even over the 1 year period, stock has done very well for itself. It's nearly a doubler over the last 1 year. No concerns with regard to street cred. And therefore, let's quickly line up the ratings on our KYC rating list. And when we line it up, of course, the first 4 metrics, we spoke about it, a clean green on all 4 of those, given the way in which this has worked operationally. Shareholding, valuations, a bit of a concern. Street coverage, a bit of a concern. Street cred is clearly a thumbs up, given the way returns have played out for shareholders. It's a 6 on 8 on our KYC rating list for KFin Tech. And to talk about this and understand this a bit better with regard to the business and what the risks could be, We have with us Shrikant Nadella, Managing Director and CEO at KFin Technologies, joining us. Welcome, Mr. Nadella. It's good having you. I want to first start off with how you anticipate growth to be for a KFin Tech, maybe over the next 2 to 3 years. There are plenty of levers for you. One is, of course, the global market, but it's the larger domestic market which you're currently leaning on. So give us some color on both of those so that viewers can understand where the business is headed.
Thank you so much, Harsh. Great to be here on your show. Very
Absolutely,
fascinating.
my pleasure.
Great coverage.
Thank you.
That's part. And KFin Tech, I think your viewers have already seen the historic, metrics in terms of the growth, its balance sheet strength, its relative, valuation, so on and so forth. Broadly, I want to start, with anchoring in terms of what is the goal of this organization, what is the vision, what is that we want to do. KFin Tech is a registrar and transfer agent. It's one of the two on the investor side of it, and one of the three on the issuer solution side of it. As an organization, it had been our stated goal over the past 5 years to create the first and probably the largest global fund administrator based out of India. It stems out of the fact that I believe the capital market infrastructure space is exactly the same place and position where Indian IT and IT industry was in the late 90s. And over the past 2.5 decades, we have seen the rise of spectacular Indian companies. And I'd like to believe that there is a similar story that can be orchestrated here as well. Our direction and our execution over the past 5 years have been in the direction, whether it is about acquiring 5 different companies during pretty much 5 years, literally one organization every single year. These are all with the with a view to get to that stated objective. Our tactical steps in terms of growth driven by either business line addition, cost optimization to significant technological transformation are also all in that direction. The top line had been growing at a CAGR of 25% and the bottom line too had been, both PAT and EBITDA level. We have completely cleared out our debt. We have no debt on the books. And in that context, we believe that we have the ability to continue to grow in the similar clip as we have done in the past 4 to 5 years.
And so Shrikant, apologies for interrupting. So you've done around 20% or so in the last 3 years in terms of CAGR. You've done a little bit more if you factor in this year as well, full financial year, right? Would it be fair to say that that's how the domestic business will continue to grow? And then you have your international lever, which should add a bit of more fillip and zinc to that number, right? So just trying to kind of add those things up.
Yeah, so our international journey, Harsh, had started not just because of the acquisition of the SN, which we have announced just a few days back. We started the international acquisition 4 years back. Today, it occupies about 5 to 6% of our total book, and it had been growing at a CAGR of 60% year on year.
Correct.
What we have also done is grow other asset classes within India, which is alternatives, pensions, private retirement schemes, and pure play tech solutions. So I believe that the Indian domestic story has the potential to grow in the similar clip. Whilst the larger share of book, which is the mutual funds, probably 24-25% could be a little too optimistic. I'd like to believe that it is late teens is a good number to go with. But the other business lines of alternatives, tech solutions, pensions have been and have the potential to grow up north of 35 to 40% year on year. And together, that will get the overall number, I'd like to believe, to close to 20% plus on the domestic side. And the international had been growing, as I said, in a much bigger manner. And overall, that will get us to the similar growth percentages as we've seen in the past few years. This is excluding the acquisition of Ascent, which I'd like to believe will add significantly higher clip growth.
I'll come to Ascent in a bit, but let me first understand, Shrikant, how you view gains in market share, because with regard to absolute AUM, you've done phenomenally well. I highlighted that as part of my metrics. But what happens with regard to market share? Is there scope for expansion of market share from here? Is there too much competition? Give us some color on that.
Oh, certainly. Market share is measured in multiple ways. One is the number of asset management companies that exist in our country, and what are the total number of AMCs that we support as an RTA versus our competition. There are only 2 companies in this country which support this piece of work. Right? Today, we manage nearly 60% of the asset management companies in India. That is one market share metric we need to track to. The second market share metric that you want to track to would be the total AUM, which is the derivative factor for the revenue that we derive out of, correct? So that is what you have published here. The total market share of the AUM is roughly about 35% for KFin Tech. The 65% belongs to the competitor, the larger competitor. There is also another important metric that we all need to track to, which is what is the blended yield that we derive. The revenue the registrar derives is a multiplier of AUM with the yield that we derive. And on that yield factor, KFin does a much better job in vis-a-vis the competition. So adjusted for that, I'd like to believe the total market share is already above 40%. Now, what are the levers that we have to improve the market share of the AUM? Now, AUM is a factor of how the asset management company itself grows its business. We are merely offering the services around the technology, operations, compliance, so on and so forth. One, by winning more asset management company mandates, and their growth can help you. Second, and obviously we've been winning more clients over the past decade. We've won nearly about 65% of all new asset management companies that have launched in the last decade. And their growth will happen sequentially over a period of time. Second, superior performance of many of our AMCs over a period of time. You have seen the trend over the last 3 years, but if you were to take a trend, Harsh, from 2018 onwards and see what is the overall AUM growth for KFin Tech, it used to be 26% and it has touched 35% at its peak. So there had been literally 100 basis points expansion every half a year on a market which itself has more than tripled in the last 6 to 7 years on the overall AUM. So I'd like to believe that there is definitely much more potential to grow the market share within the AUM. There is yet another metric I'll draw your attention to, which is the market share of SIP. Market share of SIP for KFin service clients is up north of 42%. Typically, that is the sticky retail book that remains within the AMC's overall market share of AUM. And we have always seen that the total AUM trends towards the market share of SIP, which means that there is a possibility that over the next couple of years or more, the trend line between the total 34-35% of our overall AUM trending towards 40% is strongly possible.
Okay, yeah, so point taken, there's scope for market share expansion. Question is, what's the aspiration therefore? Would you look to grow 100 basis points in terms of market share every year? That's my first part of the question. Second is, your equity AUM market share is fluctuating a bit or largely on a flat line kind of curve over the last 4 years. Would the aspiration be to grow that? And the underlying question to that is it better yielding, and therefore a growth there would significantly impact your numbers?
So if I have explained, so ability to increase our market share is pretty limited.
Okay.
KFin Tech is not the manufacturer. We do not sell mutual funds. We merely service the mutual funds that are sold by our clients.
Sure.
So when you talk about our market share, you are really talking about the combined market share of all our clients put together. So there is precious little that I can do to improve the market share, apart from, of course, delivering, fabulous services. As I said, however, that winning several new client mandates is an important step in the direction. And since in the last decade or so, we have won more AMCs than lost. So what it does is that several of the asset management companies take up north of 4 to 5 to 6 years to be able to establish their cred and grow much faster. We are at that inflection point where several of our AMCs, we believe, are going to outperform the industry, and that will improve our overall market share.
Point taken fully. Appreciate that. I want to understand chances of yield compression. It's a competitive industry. Even the distribution industry is facing some challenges with regard to yields. Are you seeing any of that? Are you anticipating any of that?
So yield compression is a pretty normal business, parameter that we look at. It is no different if you look at any business for that matter. I mean, if you're dealing with manufacturing, you're dealing with logistics, so on and so forth. As the volumes increase, there is always a volume-driven discount every industry tends to offer. And part of that is because your costs do not tend to linearly increase commensurate to that of increase in your total revenue. And it is in that recognition and being a true partner to our AMC clients, we are always passing on some amount of scale benefits that we get to the AMCs in the form of yield, and which basically results in the form of discounts that we give in the form of yield. What is an important metric to track to is always your increase in AUM and overlay that with the decrease in the basis points. And when you take a look at all of those factors put together, are you still able to grow, close to about 20 odd percent is a metric. And that is something that we are confident we'll be able to do it. Our contracts are all designed to have telescopic pricing, which means that once the AMC goes past a particular threshold of AUM, there are inbuilt discounts already baked into it. Hence, this is a very natural phenomenon, something that had been happening for the last 25 years. It is nothing new, and I'm not overly worried about it.
Absolutely. Understood. Understood. I'm going to ask you two quick questions. The first one is with regard to global foray, and I'm running out of time. But with regard to global foray, your current global business contributes around 20%, and I'm including Ascent, taking that liberty to just add Ascent's top line as well, annualized, around 20 odd percent of your top line now. How quickly can it increase in terms of pie? What would the 2-year likely guidance be?
So we do not give guidances, Harsh, but let me tell you that we, once the acquisition is complete, the total share of international revenue to that of KFin's overall revenue would be about 25%, be a little over the 20% number that you mentioned. We are working towards getting that number anywhere between 40 to 50% over the next 5-year period. Part of that would be through direct growth of SN Fund Services itself organically. And KFin Tech's own international fund services business has been growing very rapidly over the past 6 to 9 months. We need to keep in mind that both our organizations' growth had COVID impact for 2 years in between when we both launched around 2018, 2019, our international businesses, where international contracting wasn't very easy. So if you take that aside, our growth had been in multiples and not in percentages. 25 getting closer to 40 to 45% would be a realistic goal in the next 5-year period. Even as the overall business itself, I'd like to believe, hopefully we'll continue to grow in the similar trajectory as we have in the past few years.
Thank you so much, Srikanth. It's been an absolute pleasure speaking and great breaking this down. It's a phenomenal business and it's great having your views on it.
Thank you so much, Harsh.
Right, with that, in fact, completely out of time on this edition of KYC. From me and everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.